Welcome to the ETF Show, taped here at the Asset TV studios in New York. I'm your host, Kristen Myers, ETF Editor in Chief at Asset TV. Small caps are having a bit of a moment in 2026, with the Russell 2000 up nearly 19% year to date. Now let's compare that to the S&P 500, which has only gained about 10% since the start of the year. And investors are taking notice. After years of outflows, inflows into small caps have jumped. To discuss, we're joined now by Chris Parker, Senior Portfolio Manager of Thrivent Small Cap Value ETF, ticker TSCV. Chris, thank you so much for joining us today.
Thank you.
So, as I mentioned, small caps are having a bit of a moment, and they've really spent years, I would say, almost living in the shadow of the Mag 7. So, why do you think investors are suddenly paying attention to small caps again?
We think there are three key arguments for the increased attention on small cap in today's market, and why there should be an increased focus within the context of an overall asset allocation framework. First of all, is the operating environment. Small cap companies are often more representative of the overall economy and overall domestic economic activity. And there's clear signs that earnings performance for the overall economy and for small caps specifically is improving. After some declines in earnings in 2023 and 2024, revenue and earnings growth in small caps both turned positive in 2025 and accelerated into 2026. In fact, if we ignore the comparison issues that occurred during the pandemic, small cap earnings growth in the first quarter of 2026 was actually the strongest since 2018. The second aspect is valuation. Right now, that improving an operating environment is being coupled with small cap equities trading at a wider than typical discount relative to large caps on several key valuation metrics that we track. Based on recent data, small cap valuations relative to large cap are trading at about a 15 to 20% discount to their 30-year average across a mix of metrics, including PE ratio, free cash flow yield, and enterprise value to EBITDA. And typically, in periods where small cap earnings growth is improving or accelerating and valuations are attractive, the asset class has generally created favorable returns. The third aspect, I think, is the diversification that small caps offer. The S&P 500 and many large cap indices have become quite top heavy recently, given the performance of a handful of companies. Um, and in fact, 40% of the S&P 500 index is information technology, another 10% is communication services. The top 10% of that index, or the top 10 names in that index, are about 40% of the capitalization. Um, and so you have this capability by investing in small caps with an improving earnings environment and attractive valuation. And you do get that exposure to the broadening of the economy, and you do get some diversification in the event that some large cap performance doesn't live up to expectations.
I want to actually dive into all three of those points a little bit more deeply, obviously, as we continue chatting. But first, I'm going to start with the valuation piece that you're mentioning. I'm curious to know if you think that there's something about the valuation story today that is a little bit different than what we've seen in the past.
I think the valuation story is a function of two things, and that dispersion is a function of two things. First, as you mentioned, the earnings performance of small cap um, being more sensitive to the general economy was not quite as robust as large cap. That was evident in 2023, and it was evident in 2024. And so, without that earnings impulse, there was a little bit of a focus elsewhere. And then, obviously, large cap earnings have performed quite strongly, or a handful of companies, large cap earnings have performed quite strongly. The second aspect of that is, um, in many cases, the valuations that some, but not all, large caps are starting to embed, has driven that spread in kind of both directions. So some of it was a Boolean optimism about large cap, and a little bit of apathy with respect to small cap. We think what's changing is the reason for apathy in small cap is subsiding as the earnings performance for those companies does start to accelerate, and investors start to realize that this is a fundamentally attractive asset class that is available at quite attractive prices.
So within small caps, why the focus on value instead of growth?
We think it's a really interesting time for value and for a quality approach to value in particular. Um, Periods of tremendous fear, or in some cases, tremendous optimism that's focused fairly narrowly within the market, both create interesting opportunities for our approach to value investing. Right now, many investors are fairly narrowly focused on a few areas that tie into artificial intelligence, and they're willing to pay quite high prices for companies that are believed to be AI winners. And a lot of everything else is being ignored a bit. But as we discussed, the earnings performance overall is improving, and there are signs of improvement in the broader economy. And the value investment universe tends to have more exposure to that broader economy than growth per se. For our strategy in particular, we look to buy sound or improving businesses that are led by capable and well aligned management teams when they're trading at substantial discounts to our estimate of intrinsic value. Um, and in this type of environment, we feel like the neglect that exists right now in terms of focusing on just core fundamental businesses that are tied to the general economy and the improvements that are occurring there is creating mispricing opportunities. We also think that that narrow focus on the first or second order winners with respect to AI, the companies that might be building out the models that are more directly tied to building out data center, et cetera, are getting a lot of focus. But we do think that there are opportunities to identify companies where they're sound businesses and where the management teams are starting to understand and figure out how to use some of those tools to run their businesses more efficiently, improve their margin structures and competitiveness, and improve growth rates. And we think that there are opportunities there that we've been able to find as well, where you have solid companies that are driving returns on capital, driving returns on margin structure. And because we're so narrowly focused on one set of cohorts, we're not quite paying attention to those.
So where are you finding, like the most attractive opportunities within small cap value? Are there specific sectors that you think are really driving some of those strong opportunities that you're mentioning?
We're finding opportunities in a handful of different areas along different themes. Um, Certainly within parts of the industrial complex, there are uh, mispricing opportunities that we've identified that are tied to businesses that are improving their competitive position, improving their margin structure and profitability, and experiencing the cyclical impulse and the improvement in the domestic economy that we've talked about. We're also in that space finding companies that are able to um, utilize the tools that are being created by artificial intelligence and other aspects to improve their business. Um, we're also finding opportunities in parts of consumer, in many cases based on fear about the resilience of the consumer, but there have been opportunities where we feel like that's overdone, and we feel like there are companies that are having kind of moments in terms of robust company specific consumer end demand that's not been fully recognized, because that would be an opportunity that might exist more on that kind of fear end of the spectrum, if you will. We're afraid about short term impacts on earnings power, but the reality is that many cohorts in the consumer are remain robust, and many of the companies in that space are able to execute on structural improvement, sustainable structural improvement that's not being recognized. Those would be a couple of buckets that we're finding some interesting opportunities.
So, Chris, I know a lot of investors think of small caps as fairly volatile. I'm curious to know if you can talk us through some of the risks to small caps, but also some of the tailwinds.
Sure. I'll start with the tailwinds first. One of the primary tailwinds, obviously, is just the generally improving economic environment. Um, the small caps do have a greater sensitivity, if you will, to changes in the economic environment. Um, the index itself is a little bit more representative of the overall economy. Industrials is a larger component of that, as our financials, and then somewhat more cyclical components of information technology. So there is a little bit more of a cyclical tilt. We're in an environment right now where the overall economic activity is what I would describe as sound and improving. And we are seeing several areas that are key parts of the domestic economy um, experiencing an uptick in growth, an uptick in revenue, an uptick in earnings and margin as we see margin leverage come through. So those would be the tailwinds. I think obviously the risk factors around that would be um, events that could potentially disrupt that improving pace of economic activity. Obviously, we're in an environment right now with a lot of exogenous items that have created some uncertainty in terms of the economic outlook and corporate decision making and investment activity. We're also in an environment where uh, the direction of interest rates is, let's call it, slightly uncertain. Um, our view is that we won't see much from the Federal Reserve when they meet, but certainly markets are pricing in higher interest rates or the potential for higher interest rates later in the year to curb inflation or inflationary risks. Um, to the extent that, for example, the Federal Reserve has to move much more aggressively on interest rates and the yield curve reacts, and that causes a slowdown in um, corporate decision making and investment, that would be something that would moderate, we think, the pace of the expansion. That would be a broader risk factor, a broader set of risk factors. And then the group itself does tend to have higher financial leverage. And so a change in interest rates that's more meaningful for some cohorts of the index would have an adverse impact. We think that's the importance of having a focus on more durable businesses, more durable capital structure, um, higher quality management teams that are capable of withstanding and ameliorating the impact of slowdowns of adverse changes in the interest rate environment, and that are able to continue to grow earnings power over time, generate attractive returns, and generate attractive amounts of free cash flow.
What are some of the biggest mistakes that you see a lot of investors making when they are evaluating small caps?
Um, we we think that there are a handful of those. I think one of the first mistakes is to think about small caps as a somewhat homogeneous group of companies and not taking into account what's really a much wider dispersion in the quality of the businesses in that space relative to large cap. Depending on the point in time, about a quarter to a third of small cap companies are not generating earnings. They're not generating free cash flow. We think a similar size cohort, based on our research, don't really have a demonstrated track record of earning in excess of their cost of capital. And for that cohort of earners, annual returns are about 4.5 percentage points higher than non-earners over the past 25 years or so. So that's a great argument, obviously, for active management. But we do think that not recognizing that really wide dispersion in quality is one of the initial mistakes. Um, we also think that that extends to the idea of management quality and capital structure durability. If you think about a small cap company versus a large cap company, large cap companies have uh, tiers of high quality management teams, um, oftentimes a deep bench. That's not always the case in small cap. And so aligning yourself with high quality, well incented management teams is particularly important in that space, in our opinion. Um, We also think that the volatility and the dispersion that exists in small cap does make it particularly important to understand not just what can happen when things go right, but also what can happen when there are adverse outcomes. And we think that properly evaluating both upside and downside for individual investments is critically important. That's a key part of our investment process is to really understand pretty explicitly what can go wrong in individual companies, evaluate that distribution of returns, and really use that as a mechanism to understand, are we getting an appropriate price relative to the downside risk that we're taking. The one other mistake that I would point to um, is the concept that small cap is a place where you just hop into and out of depending on um, the macroeconomic environment or other bigger picture factors. Those factors certainly help, but the reality in our view is that when you focus on profitable cash generative companies that grow earnings power over time, you can often find those at fairly substantial discounts. And in many cases, those companies eventually grow into high quality mid caps. So if you have a more patient, quality through the cycle approach to investing in small caps, you can potentially capitalize on those opportunities that you might miss, quite frankly, if you were just hopping in and out of the space, depending on purely a view on interest rates or the economy or other factors.
I'm glad you mentioned that point on patience. I'm curious to know how patient is patient that a lot of investors need to have for that, small cap allocation to really work inside of their portfolios.
Um, it's partly I think I would frame it this way. Um, if you have the right approach, you can definitely be patient. The right approach does, in our view, have a quality bias to it. It does have a focus on, sound companies that are able to um, grow earnings power, that are able to generate earnings and cash flow even when things are slowing. Um, when you align yourself with management teams that have demonstrated capability to take advantage of the opportunities that exist in their industry, take advantage of capital allocation opportunities, in some cases, take advantage of capital allocation opportunities that come during downturns. Um, and that uh, and the ability to take advantage of mispricing. All of those factors do allow you to take a more patient long-term view. Our focus is on owning companies over a 2 to 4 year time frame. We feel like that provides us a window to be early on in fundamental improvements that are occurring, be early on in recoveries that are occurring in businesses and identifying mispricing. But our ability to be patient really is a function of the types of businesses that we buy, the types of management teams that we focus on. And then for our strategy in particular, quite frankly, we do look for companies that are growing earnings explicitly because we know that over time, even if share prices don't move, if we're growing earnings power, the undervaluation is building, and we think of that as a coiled spring to generating returns. So I think your ability to be patient, quite frankly, is a function of a sound investment strategy, more so than any specific time horizon or anything of that nature.
I want to ask you now about the market leadership that we've seen. It has firmly rested in in the grasp of tech companies. But if we do see that market leadership really widen beyond tech and those big tech names that we've all been chatting about a lot recently, what role do you think that small caps have to play as we see that sort of market leadership expand?
Well, I think if I go back to one of the early points that you made, small caps are up nearly 20% year to date. The S&P has lagged that. I think that's the early signs of a demonstration of the fact that leadership is broadening. Um, and we're seeing that occur as well in terms of what's driving earnings growth in small caps and the acceleration that's occurring there. Um, and so we think that at this point, our view is that economic activity and earnings growth for small caps will remain solid. And that as that occurs, given the undervaluation that still exists in small cap, um, we would anticipate that performance and that broadening would continue.
Thank you so much, Chris Parker, Senior Portfolio Manager of Thrivent Small Cap Value ETF. And thank you for tuning in to the ETF Show.